everybody, and welcome to This and That Retirement Edition. For this episode, we want to discuss NUA, Net Unrealized Appreciation, how that relates to your low-cost basis shares. So for now, we want to stick with definition of NUA, your savings plan statement, as well as hypothetical example.
In front of you, you see the definition that we took from Investopedia.com about NUA, and what it means is that the difference in the value between the average cost basis of your shares and the current market value of the shares that you have in a tax-deferred account. In your situation, you might think, well, how does that apply to me? You may have bought company stock a long time ago. Let's say it was $20 a share. That's currently trading at $80 a share. The difference there is $60 worth of appreciation. The net unrealized means you just haven't sold it yet. And so that can be important if you're distributing highly appreciated company stock from your tax-deferred employer-sponsored plan, such as your 401k. It allows you to get capital gains or long-term capital gains instead of ordinary income. So let's take a look at your savings plan statement, something you're probably very familiar with, to see if you have some of the components that make this eligible or easier to do upon your retirement and your savings plan distribution. So on the bottom of that page on the left-hand side, what you see is an after-tax balance. That's usually step one for us. We like to check and look and see if you've got any there. Now, if you do, you're moving on to the next page, and we're going to look at your company shares that were purchased. And at the bottom of that page, it's listed out nice and neatly for you. And you can see in this hypothetical example, we doctored it up so that this individual has $11 to $15 range of old shares. And over here in the stock match account, you can see we've listed 500, 200, and up to 1,100 shares in that range. That total conveniently adds up to $3,000 for this explanation. And the total cost basis is that same $40,100 tax paid. So if one wanted to exchange the tax paid for the shares at retirement, how would that look as opposed to somebody who didn't do anything? So when we look at an example, let's just call the left-hand side A and the right-hand side B and look at two different scenarios. I want to keep in mind, though, the things that are the same is that in both scenarios, we're assuming, say, somebody has $1 million and they still have that $40,100 tax paid. So draw that on both sides here. What would happen inside A if they said, I don't want to exchange it, I don't have any tax or lower cost basis shares, just send me the $40,100 to my personal checking savings. So you got $40,000 roughly that goes over there, which means the remaining $959,900 would go into your IRA account. Now, alternatively, if somebody did want to exchange the tax paid for their lower cost basis shares, remember we said in the previous pages you had about 3,000 of those company shares, and if the value is at $80 a share, that means you've got about $240,000 in that account, which means the remaining $760,000 would go into the IRA account. Now keep in mind, there's no free shares, there's no money added. Both situations you've got $1 million. But what you do have is a different amount of money in this account versus this account. There adds some flexibility there, because this account over here is taxed at long-term capital gains, and that's different than money that's taken from the IRA account. Now, let's say an individual was thinking they needed about $40,000 to live on that year, and they wanted to pay their house off for $100,000. Well, what would the difference in taxes be if you took it from here versus over here? And on the following pages, we'll go through that scenario. But before I do that, remember that tax paid dollar that you have here, just because you're exchanging it in your embedded cost basis. So if you had $240,000, minus that cost basis, it ends up being you pay taxes if you sold it all at one time on $200, not the $240, and you actually get a statement of distribution sheet showing you your actual cost basis per share. And you don't have to sell it all at one time. You can sell as little as much as you want. But let's go back and look at this scenario and see what the difference is.
We're going to review two hypothetical tax projections with you. They both have the same scenario where the taxpayer is taking out $100,000 to pay off debt and $40,000 for living expenses. As you can see in this first tax projection, the distributions will come directly from the IRA. And so we scroll down to see that the taxpayers need to take out $170,732 from their IRA in order to net the $140,000. The reason why is all of this will be taxed at ordinary income, and the ordinary income tax on this would be $30,812. And please remember, this is federal taxes only. When we go to the next tax projection, you can see the taxpayer still wants the same amount, except this time we will take the distributions from the NUA or low-cost stock account. So in this scenario, the taxable income will be reported on line 13 as capital gains. And the reason why this is a lower taxable income amount is because the taxpayers have tax paid cost basis that you will not need to tax twice. And here on line 44 we can see that the capital gains tax rate is lower than the ordinary income tax rate. And in this scenario the taxes would be $5,145.
Well, thanks for watching today. We certainly appreciate it. Obviously, some of this information is going to be dated very soon, so keep that in mind. But if you'd like to talk to us in a little more detail about your personal situation, just give us a call at the numbers listed below.
Thanks again for watching.